Hello and welcome to FT Markets. Today the topic is China, the world's second largest economy, which appears to be slowing down. What we're going to think about today is who is most exposed to China as this happens. And to help us do that, we're joined by Nikolaos Panigirtzoglou, global market strategist for JPMorgan. Nikolaos, so how should we be thinking about who is exposed to China?
The exposures to China have primarily three manifestations. The first one is banking linkages, the exposures that foreign banks have on Chinese entities, bank and non-bank entities in China. Second, portfolio at FDI investments. And finally, trade. If I think about the first one, which is banking sector leakages, we reckon by using BIS data that there are around 1.1 trillion of foreign bank exposures on Chinese entities. Around 500 billion of that reflects local operations in China. The countries that have the biggest exposure of this $1.1 trillion of total foreign bank exposure to Chinese entities, the countries that have the highest absolute exposure are the UK, the US, and Japan. When we look at the exposures relative to the size of the banking systems, then we have Asian countries ranking high. We have Korea, Taiwan, we have Japan, and among Europe, the UK. One shortcoming of the BIS data is that it perhaps underrepresents or doesn't specifically separate the exposures to Hong Kong and Singapore, so we believe that these two countries are also ranking high in terms of their banking exposures on Chinese entities.
So it's the neighbours, as you would expect, when it comes to banking.
Indeed.
But what about the foreign direct investment, some of those linkages that we've seen a lot of?
Indeed. What we find there with both FDI and portfolio investments is that offshore centers such as Virgin Islands, Bermuda, Cayman Islands account for the majority of the FDI investments. Around 40% of the $1.8 trillion of FDI investment exposure to China is effectively owned by these offshore centers. Beyond offshore centers, what we have is Netherlands, which is to some extent also a tax haven, and after Netherlands we have Taiwan, South Korea, Japan. Again, the neighbors of China being more exposed in terms of FDI investments. In terms of portfolio investments, the biggest exposure is to centers where investment funds are domiciled, such as the UK, the US, and Luxembourg. And that effectively shows that most of the owners of portfolio assets in China, Chinese assets, are effectively foreign investment funds domiciled in these jurisdictions.
And I guess the third part of that is trade. And so I think we've got one more chart here to look at, which gives us some sense of this.
Yes. There are two ways in terms of thinking about trade. One way is to look at what we saw in this chart, which is the net export similarity to China. Obviously, the currency depreciation, which China began in August and is spending, and perhaps is going to be a multi-step process over the coming years, is hurting the countries that are competing in export markets, global export markets, via effectively exporting similar products to China. And that net export similarity index shows that beyond China's neighbors, such as the Philippines, Singapore, South Korea, India, and Japan, we have Italy there ranking high, which is much higher than the ranking of Germany. People, most people would think that Germany is the European country most exposed, but when you think about net export similarity, actually Italy ranks higher than Germany. But beyond these two European countries, again, it's mostly the neighbors of China led by Philippines, Singapore, and South Korea that are most exposed.
And this means maybe it's not the dollar, but perhaps some of these countries whose currencies we should be thinking about in terms of.
Indeed, and that's one of the implications of the Chinese renminbi depreciation, is that it de-anchors the role of EMFX space, because effectively Chinese renminbi is becoming the benchmark for the region, and that's especially true for the main trade competitors of China.
Great, well thank you very much for that, Nikos. As we think about the effects of China slowing down, some of the consequences may appear in some surprising places.